Hello, and welcome to the February market update from Commonwealth Financial Network. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. After a great 2019, 2020 started with a bit of a setback. In January, we saw two of the major U.S. markets down a bit. The S&P and Dow were both down a bit, not much, less than 1%, and the NASDAQ was up as tech continued to power forward. Internationally, we saw a lot worse results. Developed markets were down by about 2%, and emerging markets did worse than that. And that led to a climate of something approaching fear, which of course benefited fixed income, which also did well last month. And the source of that fear is actually what we're seeing in the headlines right now, the coronavirus from China. It looks like a pandemic. It looks like it's spreading very rapidly. But when you start to look under the covers of the data, it doesn't look quite as bad. Yes, it's spreading rapidly, but a lot of that may be just we know better what's going on because the policy response has been much, much better than what we've seen before. The other thing is the mortality rate is much lower than the last time this happened with SARS in 2003. So this is certainly something we need to keep an eye on, but just as with SARS, it's very likely to be taken care of and not to be a long-term problem. At least that's what the markets seem to be saying. Because although we did see a significant pullback, it was a very limited pullback. And in fact, we're actually starting to see a bit of a bounce off that as markets start to adjust to the idea that yes, this is something to keep an eye on, but at the moment, it's not nearly as bad as it could be. And that's important because when you look apart from the coronavirus, things are actually pretty good. Economic growth here in the U.S. continues to do quite well. Growth in the last quarter of last year was at the same level as the third quarter, so we're having steady growth, and that's not a bad place to be. And actually, when we look at the growth for this year, it may well do better. We're seeing some positive signs here. Last year, we saw consumer confidence pull back meaningfully. Now we've seen it bounce. In fact, we're seeing it get back to some of the highest levels we've seen in this recovery. Consumer confidence means consumer spending, and that continues to do very well. When you look at business, we also see business confidence improving. We see manufacturing, which was in contraction for several months, has just moved back to expansion. When you look at business confidence in general, even outside the manufacturing sector, that also continues to do well. Housing, in fact, is a great indicator of how people in general are feeling, and housing continues to do very well indeed. In fact, some parts of the housing market are as strong as they've been since the last housing expansion, and that's a big deal. Big picture, do we have risks? Absolutely. But a lot of those risks are receding. The coronavirus might recede. Impeachment is just about over. Brexit is happening. In other words, we certainly want to keep an eye on the risks, but we don't want to worry about them too much because they seem to be receding. And when you look at the fundamentals, they should provide a pretty good cushion for anything that does happen. So that's it for this month. Join me again in March for the next update. But until then, if you're interested in this, be sure to check out my daily blog, The Independent Market Observer. Until then, thanks for watching.